In the realm of the nation's financial behemoths, a sobering trend is casting a shadow over their balance sheets, the swelling tide of troubled commercial real estate loans. What was once a cushion of reserves has now been eclipsed by the mounting burden of bad debt, a stark reversal that spells potential trouble for the largest banks in the United States. The challenges surrounding commercial real estate debt arise from a blend of factors that have intertwined to form a precarious landscape for both lenders and borrowers. Several pivotal issues underscore this. Firstly, there's a concerning uptick in delinquencies and defaults on commercial real estate loans, signaling the strain borrowers face in meeting their repayment commitments. This strain could stem from diverse factors such as economic downturns, shifts in consumer behavior, or oversaturation in specific real estate markets. Secondly, banks and financial institutions holding these loans are exposed to substantial risks of losses should a sizable portion of borrowers default. This risk escalates especially when the value of the collateral, the commercial properties, diminishes, complicating lenders' ability to recover investments through foreclosure and asset liquidation. Moreover, banks typically allocate provisions to cushion potential losses from delinquent loans. However, inadequate provisioning to cover actual losses can deplete the bank's capital reserves, undermining its financial stability. Further complicating matters, regulatory bodies closely scrutinize banks' exposure to commercial real estate lending, given its systemic implications for the broader financial framework. Institutions found lacking in risk management or capital reserves may face regulatory repercussions. Additionally, the inherent volatility of commercial real estate markets, influenced by variables like interest rates, economic climates, and geopolitical events, adds another layer of uncertainty. Abrupt fluctuations in market conditions can impact property valuations and rental income, thereby affecting borrowers' capacity to service their debt obligations. In essence, the challenge with commercial real estate debt lies in the potential for widespread financial turmoil if not diligently managed by lenders, borrowers, and regulators in concert. Banks don't have enough reserves. The figures speak volumes. At banking giants like JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Goldman Sachs, and Morgan Stanley, the average reserves have dwindled from a robust $1.60 down to a mere 90 cents for every dollar of commercial real estate debt, where borrowers have fallen behind by at least 30 days. This dramatic erosion unfolded over the past year, coinciding with a nearly threefold surge in delinquent commercial property debt, soaring to a staggering $9.3 billion. Michael Barr, the overseer of bank supervision at the U.S. Federal Reserve, sounded a cautionary note, emphasizing the regulator's close scrutiny of banks' commercial real estate (CRE) lending practices. Yet despite regulators' warnings and the escalating risks in the commercial real estate market, loan loss provisions have paradoxically thinned, raising concerns about whether banks are adequately prepared for potential future losses. Beyond the confines of these banking giants, the broader U.S. banking sector grapples with its own set of challenges. The value of delinquent loans tied to offices, malls, apartments, and other commercial properties has more than doubled in the span of a year, soaring from $11.2 billion to a daunting $24.3 billion. Bill Moreland of BankRegData, a firm specializing in lender data analysis, paints a grim picture, asserting that the allowances for these looming loan losses must be significantly bolstered. The recent upheaval at New York Community Bank, which saw its market value plummet by over 50% following the revelation of substantial potential losses in its commercial property loan portfolio, underscores the severity of the situation. Central to the issue are loan allowances, the provisions banks set aside to cover future losses on delinquent loans. However, the determination of these provisions, traditionally based on historical loss rates, now faces scrutiny in the wake of the COVID-19 pandemic. Some experts argue that relying solely on historical data may be short-sighted, advocating instead for a more forward-looking approach that considers current delinquency levels and the potential impact of persistently high vacancy rates. Bankers, however, maintain a semblance of confidence, asserting that they are prepared to weather the storm. They point to the fact that their reserves were higher than necessary just a year ago, and now, as delinquencies rise, these reserves are being drawn down accordingly. Yet, skepticism persists, especially regarding the exposure of smaller and mid-sized banks to the CRE market. Amid these uncertainties, the stark reality remains. The banking sector may be ill-prepared to face the looming challenges in the commercial real estate landscape. With reserves dwindling and delinquencies mounting, the resilience of the sector will be tested in the coming months and years.